Hey guys, just wanted to shoot a quick video here to talk a little bit about contango and backwardation and also the VIX curve structure. So there's been a few questions about that. So pretty important concept, and today was a really good example to show you guys and explain. So the blue line here on the graph that we're looking at is yesterday. So that was the VIX curve structure yesterday. That's what we would call backwardation, where the front months are low and then it just gradually goes up over time. Today, with the volatility spike, we've gone into backwardation where the front month is actually higher than the next couple of months. Okay, so contango is a term that comes from the futures market. So let's pretend that that blue line there was oil futures. So I could go in here and I could buy oil, a barrel of oil, for say $12 today, or I could buy it for $13 in 41 days from now. Okay, now the reason it's higher in the future is because the person I'm buying it from has to store that oil for 41 days. So they have to pay storage costs. It's called cost of carry. So it's cheaper to buy it now than it is to buy it in the future because there's that cost of carry, holding cost, whatever you want to call it. And it's the same with VIX futures. Generally speaking, people are willing to pay more for VIX futures in the future because there's more chance that a market meltdown could occur. Okay, so this is the normal situation you're going to see 90% of the time. Then every now and then when we get this volatility spike, we go into backwardation. So this doesn't happen all that often, and it's just when the front month or the early months are above the back months. So you can see there's a little bit of backwardation at the front here, and then in the back months we're still going into contango. Now also another important concept to understand in terms of the VIX curve structure is that not all months, you can see here over the course of the day, not all months have been affected the same. So there's been a big spike in August futures in volatility, whereas the back months haven't been affected quite as much. So if you're getting long volatility in options, and part of the problem with hedging by long-term strangles is we've got Vega in the back months here, and we get a little bit of a bump up in volatility because we're long Vega here. But if we're short Vega in the front months, we're getting hit a little bit more because the short month, the trade that we're short volatility the volatility has risen more. So that tends to happen a lot when we get one of these little mini panics in the market. The front months will shoot up and be affected a lot more. So when we say there was a volatility spike, it doesn't mean every month's worth of options have been affected the same. So you might find that you're short some options in August that got really affected by volatility, and you're long some options in October and you didn't gain much from those ones in October. And the reason is because not all of the months on the curve have been affected in the same way. So hopefully that clears that up for you guys, helps you out. Again, we'll cover that a lot over the course of the trading course, but I thought it was a really good day today to illustrate that for you guys. So I hope you enjoyed that. Any questions, just let me know. Cheers.